Hey, welcome back to Two Super Guys Trade Stocks. I am Dylan.
And I'm Vinny.
And today we're going to look at why the Qs are outperforming the SPY, what that means for the whole market, and why the Federal Reserve is kind of still screwing us. And kind of an interesting Barron's article.
Two Stupid Guys Trade Stocks.
Scary chart right there.
Scary chart. Do you want to talk about, you put this in a video last week.
Yeah, so basically what you're seeing there, this is the Federal Reserve balance sheet. And those two kind of like spikes there, consecutive or continuation of the spike, is this new facility that the Federal Reserve created, which allows the banks to borrow at par or face value from the Federal Reserve. You know, you're talking $300 billion in like the first week, and then I don't even actually know the dollar figure for that second segment of the line there. But basically the last 6 months or more of quantitative tightening
billion.
is almost back to par value. People will argue that them directly buying assets versus giving loans out are different in terms of their effect on the monetary supply, which I do get. I just, I can't definitively say whether or not that's true or false. I don't know. I'm not a damn economist, but that's what you're seeing is like a lot of money kind of flowing into the system through the Federal Reserve, giving out these loans.
It essentially they went up 300 billion and then another 150 billion. So
Perfect.
Solid, yay! Yeah. But there's one thing I wanted to look at in this Barron's article. It was pretty interesting because before the whole bank crisis, way before this, okay? So even before the failure of SVB, the Fed's January senior loan officer opinion survey showed that percentage of banks tightening lending standards had risen to 44.8%. This is before all this crap, right? That's not good. That's a problem because we just got way worse after this whole banking crisis. So lending is going to be a problem, all right? This is a little bit of like just number analysis. You always got to take this with a grain of salt because you're just using past numbers and trying to make a pattern, right? But essentially what this is saying is, hey, are we in a bull market after the bottom of October? Is that why we're going up so much? Or is this just a bounce before the inevitable fall? That's the $1 million question. That's what everyone wants to know, right?
Absolutely.
So since 1974, the S&P 500 has gained on average 32% in the 6 months following the low, the previous low, the bear market low, okay? The smallest gains was 1987-2002 when the index rose just 13%. So it's possible for the stock market to still close the gap. We still have 2 more weeks. But is this one of those periods where, the Fed's still raising rates, and none occurred when the yield curve was still inverted as it is now. So there's been no actual comeback while we are still inverted. So you could argue this is not a bull market, right? Which it's not very popular to say, but
Yeah, you always have to cherry pick the data too, because there's also that question about when the first Federal Reserve rate cut comes and the market bottom. Since like the 1980s, the market bottom has only come once before the rate cut. But if you go all the way back throughout the entire history of kind of the SP 500 and the Federal Reserve, it's actually like 50-50. And Chairman Powell has been very specific in saying that this is truly a unique time in terms of a Fed market kind of cycle, because this was spurred by something unusual in terms of this massive wave of new cash printing and inflation. And this one may act entirely different from ones in the past.
Yeah. Honestly, they're all kind of unique. But to sum up kind of what you're saying, we did a video because there was a hypothesis that the market bottoms a full 6 months after the last rate hike. So people are waiting like, oh my gosh, when's the last rate hike? Or rate change. Sorry, was it rate cut?
It was after the cut.
After cut.
The market wasn't until the first cut, basically, was the original hypothesis. And it was like somewhere around like 2-3 months, somewhere in that ballpark is what I think the conventional wisdom used to say. But like I said, that's cherry picking data that's just since the 1980s.
Absolutely. So this was interesting in there. So basically, the Fed looks like it's coming to an end of its tightening cycle. Something has been mentioned as a catalyst of a market rally, but investors are applying lessons of the past 24 years, a period of deflation rather than those of the 15 years before that, which can safely be described as inflationary. So during the deflationary stretch from 1989 through 2018, the last rate hike was followed by 6 months of strength. That's what everyone's saying, right? With the Dow Jones, going up, return average 13.1%. But during an inflationary period, which ran from 1974 through 1984, cherry picking data, the Dow dropped an average of 6.4% over the months following the last increase. You gotta take this with a grain of salt. It's interesting, but it reminds me of those guys, like those day trade scammers that show you a graph and are like, if you just like short here, you're gonna make $1 million. Because it's right there. Like, you're using past data. All right. But there is one very interesting thing that's happening right now. Okay. Let me move your face. So the SPY top 10 holdings on the left here are, Apple, Microsoft, all the stuff. Okay. The red circles are just friggin' killing it and make up 1/5 of the SPY. Okay, and I'm not saying that Berkshire, Amazon, Tesla, United Health Group are not going up. It's just, United Health Group is not, but the other three just aren't making insane gains, right? Yeah. So we have this weird crisis. Here's the SPY. Okay, you have those stocks making insane gains, which I'm going to show you. Let me move my face. And we're still hanging out above this 200 moving average. It's kind of odd. Okay. Then you have the Qs. Yeah, it could be. Then you have the Qs. Almost, you can see my mouse, right?
Yeah.
Almost beating this peak. They keep on trying. They're having big volume days, and then it's a Friday. You can't put a lot of, weight on that. It's like almost there. But here's the thing. You look at Apple making, $20 in a month. You look at Microsoft, $40 in a month. Remember, this is 20% of the SPY. NVIDIA just shooting up. I hate my life here. If anyone wants to know, I sold right here. It's Perfect. This little doji, if you're curious. Freaking idiot. Google also up 20% in a matter of like 8 days. Probably 12 days. And then you have Meta. Jesus Christ. Also, if anyone's wondering, sold right here. Idiot. Yeah, and then you have the entire financial sector just getting wrecked. So this is XLF. This is not any banker in particular, but this is essentially if you're just trying to get financial exposure, you don't want to put your money in any single bank. This is wild. Mm-hmm. The fact that we're having the Qs almost about to set new highs. We have like 8 stocks that are 20% of the entire average, just absolutely killing it. And then we have this whole crisis going on. That to me shows that we would be at or near a tipping point, right? If the banks, which it's very possible, recover soon, I don't think they're going to, full disclosure. I think this is going to be a problem for a while. But if they start to go back up and reclaim the value or near the value they were at, the SPY is going to absolutely take off because they are being weighed down by just a bunch of underperforming stocks while 20% of the market is shooting up. Now, the opposite of that is they can't shoot up forever. So if those 20% go even for a 5% correction, which is very well within the realm of possible when you're up that much, that's, the SPY is going to lose 10 points easy, and that can cause a whole bunch of problems. So it's a very interesting time because the entire SPY is being buoyed by 10 stocks.
What if I told you I just put an aggressive bearish bet on NVIDIA?
Honestly, I kind of want to too. I learned you should never time the market for investments. I time the market for trades. And NVIDIA looks gorgeous for long term, but they're not worth this much right now. This is like EVs. You say the word AI and everyone's like, oh my God. Whoa. It's like,
yeah, exactly.
I was using ChatGPT and it couldn't even do addition. I'm going to say that again. Real quick. This artificial intelligence couldn't do 8-digit plus 8-digit addition if you had to carry the one at least once. Couldn't do it.
Wow.
I think that's been solved, probably. Maybe
Hopefully.
not. Just do a bunch of
Yeah.
digits on yourself. Tell me if it works. But AI is not where we think it is. Just throwing that out there.
All right, pretty fascinating stuff. I'm kind of I'm curious because obviously the banking confidence is the key there in the banking sector, and it's going to take a while before that comes back, right?
Mm-hmm. Yeah.
Yeah, even if we kind of have no more bank failures for a little while, it takes a while before people kind of forget that just happened.
Yeah.
So I can't see them buoying the market anytime in the not too distant future. And those graphs for the major tech stocks definitely look a little extended to me, but I'm just a stupid guy.
Are you heavy cash right now?
So a little bit. I want to say 20, 25%, something like that.
Okay. I'm still 60% cash. So I don't want to buy the tech stocks at that price. It's just I mean I want to be investing them. I made a mistake selling. But I'm more inclined to buy Bank of America if it hits 20. Like I'm not it's not a good deal right now. They're too extended. So,
Yeah. All right, guys. Well, let us know what you think on the comments down below. We'd love to hear your thoughts.
have a good one, guys.